watching Market Wrap, a weekly update on equity markets and outlook for next week with Mr. Pankaj Pandey, Head Research, ICICI Direct. Sensex and Nifty hit fresh record high, and Pankaj was of the opinion that Nifty is heading towards 19,000 plus levels. And this is not now that he has been talking about it, but it has been several weeks that he says that Nifty and the markets are headed towards new high. Very good afternoon, Pankaj, and welcome to the show.
Hi, good afternoon, Geeta.
Pankaj, your expectations, your predictions come true. Nifty hits a fresh record high, Sensex at fresh record high, and this week we saw activity happening in the mid cap and the small cap space too, with they outperforming the broader benchmarks. So, where do you expect the markets to head from here now?
Well, yes, market continues to make new highs. Our sense is that in the shorter term, we would expect Nifty to touch 19,400 kind of a levels. But having said that, our sense is that probably we might see some bit of a profit taking also at current levels. So probably 400 to 500 point kind of a correction cannot be ruled out. But
Okay.
overall, we are headed higher and we have revised our short-term Nifty targets to 19,400 levels.
Mm-hmm.
And like we have been saying earlier, the laggard sector are expected to do well. So we have seen metals doing well. We have seen real estate as a sector sort of doing well. Mid
Mm-hmm.
caps have done well this particular week. IT, there is a good amount of bounce back we have seen largely because of the dovish commentary coming from the US Fed. So I think all in all, our sense is that what you're seeing is more of a broad-based participation across major segments. And given the
Okay.
fact that the volatility is below August last year levels, so there is no panic in the market overall. And our sense is that even if there is a profit taking, one should not really panic. Overall, our sense is that Nifty is headed for new highs. In the interim, 19,400 is what we are putting.
And this has been possible just because our economy is doing better than the global, other developed and developing economies. So, what is that you saw in the GDP numbers this time? I mean, it were as expected. If you talk about the GST collection figures, that have been really buoyant. That stay above 1,40,000 crores. Uh, Overall picture, you still stay bullish on the Indian markets in the long term, yes, but in the short term, do you expect some kind of a cool off coming in the markets? Because everything is priced in.
Correct. So we have seen a decent amount of rally overall, and we could see some bit of a profit taking also happening, and which is why probably 400 to 500 point kind of a near-term correction can happen. But like I've been saying, what you're seeing now is a more broad-based sector participation. So you'll have some sectors which will sort of do well. So for example, in this particular week, while Nifty was up closer to 1%, we have seen metals doing exceptionally well, closer to 4%. Real estate as an index also did 4% because of an anticipation that if interest rates are or inflation is lower, probably interest rates also may not get hiked so much. Similarly, mid caps have done very well, so they're up about 3 odd percent. So they're doing a bit of a catch up. Our sense is that mid caps and small caps will continue to do some catch up. And last but not the least, I think IT is making a decent amount of comeback. And mind you, this is one sector besides banking which is carrying one of the highest weightages. So our sense is that overall you are seeing a more of a broadening of the participation of this rally, and even there is a near-term correction, one should not get worried. Now coming to economy, I think overall since your input cost prices have been sort of trending lower, I think this is one of the biggest positive. GDP numbers were okay in terms of 6.3% kind of a growth. I think second half is usually better. But this year, our sense is that we'll be touching about $3.3 trillion in terms of economic size.
Okay.
GST collections are far more robust than what the government had penciled, and so government average monthly expectation was only 1.3 lakh crores. What you're getting is nearly 1.5 lakh crores, so 20,000 extra is what you're getting on a per monthly basis. And our sense is that the extra money, what they are going to get, I think FMS clearly hinted is that the infrastructure will remain focused. So I think which is a better template for growth because it has a multiplier effect on the overall economy. So I think
Okay.
domestically, most of the things look sorted.
Let's talk about the auto space, which has been, outperforming in last several months. I think 8 to 9 months now. But slowly, auto is losing steam following, sales numbers that we saw. How did the sales numbers, looking at the sales numbers? What do you see the future for auto space as such?
So I think November numbers or even for the month of December, we would expect some bit of a softer or a muted set of numbers, largely because as the year end approaches, people tend to sort of postpone their buying because obviously because of the year change. So I think what you're seeing is sort of a pretty normal kind of a phenomena. But having said that, when you look at segments, whether it is two-wheeler, whether it is CV, whether it is three-wheelers, all of them have witnessed a double-digit kind of a month-on-month decline. PV was relatively better. The decline was on single digits. Similarly, tractors is still sort of holding up very well. And within two-wheelers, I think all of them have witnessed a good amount of decline on a month-on-month basis. On the PV side, I think Maruti did relatively better. So degrowth was only 5%, whereas PV, UV or vehicle segment for them grew 5%. So that was a pleasing part. Otherwise, I think overall OEM numbers were a bit sort of tad muted, but I think something similar is what you would expect even for the next month. That is largely because of the year-end change. But our sense is that you will see for autos overall margin recovery to pan out because the input prices are softer. Crude oil prices has been sort of cooling off, and obviously that puts a relatively lesser pressure in terms of operating cost. So we continue
Okay.
to remain bullish. YTD numbers will look quite robust. So month on month. And also, what happens is that if the festive season is in different months, then accordingly you see this kind of a variation in numbers. So I
Okay.
think bit lower, but nothing alarming to say that or to conclude that auto is headed for a slowdown. I think the bookings are still sort of good. There's no negative commentary which you have got from most of the managers. So that way, I think the outlook remains bullish for auto as an overall pack.
Pankaj, if we see everything is not all right as far as the global economic scenario is concerned, Eurozone is still facing pressure. US is still, there are fears of recession, though Fed chairman has, indicated that the rate hikes would not be as aggressive as they had been in the past. But we have seen a good recovery in IT, be it the Nasdaq, be it in the domestic markets that we have seen for the Nifty IT index and for the individual stocks. So, do you think the kind of recovery that we have seen in the stocks and the levels that these stocks are trading at is the right price to really enter, or you will expect a little bit of slowdown and cool off, and then one should really enter? Who has to take the fresh position in the IT space?
So I think tricky question, but when you sort of look at US rate hikes, they've been hiking rates very aggressively, and I think the impact of that will be visible in the next 2-3 quarters. Full
Hmm.
impact. As of now, what
Okay.
is looking like is that the future rate hikes or quantum of rate hikes will get tempered, and which is why
Hmm.
probably further rate hike of say from 4%, 5.25 was expected. Now probably what yields is suggesting is that the overall hike could be lesser by 50 odd bips. But that's sort of a bit directional. I think on the overall IT as a spend, we still don't have much of a clarity in terms of the kind of impact it will have in terms of whether what kind of recession or whether it will create recession or not. So that
Okay.
is still a sort of a data to be watched out for. Probably it will take some time. But what is
Hmm.
pleasing is that the Fed has gone a bit dovish in terms of the quantum of rate hikes. So they are now
Right.
cognizant of the fact that it might impact growth. I think that is why there is a bit of a relief right now. It is very difficult to put in terms of numbers, in terms of what kind of growth rates IT can deliver.
Okay.
Similarly, for IT companies, 25% of their revenues is coming from, say, Europe as a region. We don't know. Europe is still struggling with number of issues. But
Hmm.
having said that, we have already seen decent amount of crack in the prices. Probably we
Okay.
would not see a big spike like historically we might have seen, but our sense is that you might see a slower pace of recovery. But
Hmm.
risk reward from a 1 year perspective looks quite okay or quite good according to us. Because somewhere down the line, next 1 year, all this will be behind us in terms of the higher prices, because inflation is also largely statistical most of the times.
Right.
So from that perspective, I think IT looks attractive to us. Technically, it has broken out of the 11 months of consolidation range. We
Mhm.
continue to like tier one names like say Infosys, HCL Tech, and within tier two, go for Gen Persistent.
Mhm, mhm. Let's talk about the sector which has really lent support to the markets and pushed them to record highs. That is banking and financial services sector. Banking has been outperforming as far as the PSU banks are concerned. We saw some kind of a momentum in private sector banks too. So, what is your status and your view on the NBFC space, which is still not seeing that kind of a momentum that we saw in the pure banking space?
So I think one credit growth overall, if you look at, was up about 17 odd percent, and we've seen sectors like say retail sort of doing exceptionally well. But when you sort of look at overall NBFC as a space, I think in a high rising interest rate scenario, they are at a bit of a disadvantage because the deposit because earlier we had a shortage of liquidity in the system, so deposit rates were going far more higher than the lending rates, and as a result of that, there was an expectation the margins will sort of get squeezed. I think if a few readings for from now on are largely on the softer side, which is what we would expect going forward, then our
Mhm.
sense is that NBFC as a space also will do the kind of catch up what other segments we have seen. So as of
Okay.
now, it hasn't really performed, but we would see. I think asset management companies are looking attractive to us because our sense is that now with equity market sort of doing well, overall investor interest is sort of inching up. So
Mhm.
typically that should have a positive rub off on some of these names. But
Okay.
overall, I think NBFCs could still take some time to sort of perform. But I think
Mhm.
setup wise, I think they're sort of getting better.
Mhm.
And which is why probably some more time it is going to take. Overall, I think BFSI banking will continue to sort of do well. I think it's a very beneficial scenario for them. You're not
Okay.
seeing the retail plus credit, even corporate credit is also sort of picking up. So that way,
Mhm.
I think overall things are sort of setting up very well for bigger banks or even PSU banks.
Mhm. Mhm. Pankaj, I was talking to somebody, I mean, last evening, and he was saying that is it right time to really enter into the PSU space, banking space, because we have seen a very good recovery from the lower levels. Some stocks are up 60%, 70%. So would it be right to really enter at these levels?
So we have been sort of refraining from dabbling in a lot of smaller PSU bank names, largely because you really do not have a track record. And I think if you are sort of investing for the first time, probably it is better to stick with tier one or bigger banks like say State Bank of India or Bank of Baroda. I think larger or the challenge with most of these smaller PSU banks is that while they may look very attractive from a price to book perspective, but when you compare in a down cycle, the kind of gross NPAs which was there in their books compared to say even SBI, those are quite large. So from that perspective, I think uh, risk also needs to be considered because if you're sort of buying, you're not buying only for the good times. You need to sort of
Right,
probably you might get bad times in between. So in
right.
banking, risk mitigation is the single most important factor. So whichever bank has displayed lower volatility or better risk mitigation, even in a down cycle, I think those are better banks. Sadly, you will find lesser PSU banks there and more of private sector banks. So I think which is why private sector banks get preferred. And within PSUs, I think it's State Bank of India and Bank of Baroda.
Mhm, mhm. Coming on to the FMCG space, the input prices are on fall now. They are falling. Your crude prices are down. Your palm oil prices are down. So, do you expect their margins to be better in third quarter?
Absolutely. I think what is looking like is that the gross margins for most of your FMCG companies has bottomed out last quarter. We've seen 10% kind of a decline in crude oil prices. Palm oil prices have I think moved to about 75 rupees a liter. So that's a kind of a hefty 50% decline what we have seen. Obviously it's a good news for most of the FMCG companies because it will help them maintain better margins. It will help them deliver volume growth. Up till now, they were taking price hikes, and as a result of that, volume growth was largely missing. So that way, I think this is one of the biggest positive news what we have seen, and which is why one day you had seen a big pop up in most of the counters.
Right.
But having said that, I think one still needs to be choosy in FMCG as a space from the perspective that a lot of these companies are quite expensive and earning growth may not really sort of sustain that kind of a. So, which is why I think Dabur with a target price of 700 or Tata Consumer with a target price of 950 and even ITC with a target price of 405. I think these are some of the stocks where we see a better risk reward going forward, or the overall growth expectation or growth outlook looks better.
Coming on to the metal space, Pankaj, this space has been quite volatile, but now with COVID restrictions, easing off in China, we are seeing some bit of traction back in the metal space. Good recovery in the steel companies, with government also, going away with the levy that it had imposed on exports. What next for metal space? The kind of recovery that we see, sustainable or not, and if sustainable, which are the best bets and the stocks that you would recommend?
So very difficult now, I think, because metal is a very tricky sector to sort of play out, especially given the fact that a lot of global factors impact. So it's a global commodity, unlike cement, which is a sort of a local commodity. And global commodity, we all know that China has been very volatile in terms of their COVID policy, which has also given a fair amount of volatility to the sector. But having said that, I think near term things have been good. Whether this sector is out of the blue, it's still early days because we are yet to see price recovery sort of happening. And on top of it, I think whether you look at the developed world, we still don't know next 3 to 6 months what is the kind of impact one would see in terms of demand destruction because of the aggressive rate hikes. So yes, closer to bottom, but whether they are going to sort of see a V-shaped recovery, I'm really not sure. But having said that, I think we still feel that some of the companies like say Jindal Stainless, where they're coming up with a capacity of 1 million tons, this is one company which is a beneficiary of the export duty removal. And then
Okay.
I think NMDC as a case is looking interesting because while we have valued the steel business at about 22 rupees, but the company has put in about 22,000 odd crores in this. Now, if they get a better value because government is looking to sell a sizable stake in this company, so probably I think it might be a good news for NMDC investors because you will see a better price discovery there. So I think NMDC looks interesting overall as a case. Along with that, I think JSL. And beside that, we would prefer more of Hindalco because next year, so while next quarter is also expected to be soft, but January onward, you'll see more or better negotiation for with auto players for aluminum supplies. So they might be able to reclaim their $525 for EBITDA per ton global operations, which is a bigger operation for us. So that way, I think Hindalco is another stock which I would prefer.
Talking about the gas pricing, the domestic gas pricing mechanism might undergo a change, which has been proposed by Kirit Parikh committee report. Uh, how do you see that impacting the gas counters?
So one is, I think a lot of it is in wait and watch kind of a situation. Because while these are suggestions, it is not necessary that the government is going to accept all the recommendations. But having said that, it does not have meaningful impact for companies like Reliance because deep water gas finds will continue to attract higher rates. But I think for legacy fields, while overall sense is that you will see lesser volatility going forward because what the government is looking to do is that they have come or what the committee is suggesting is a price band, and then you'll have annual escalation. But I think if there is a full decontrol after 2027, while it is structurally good, But if it increases the cost for city gas distribution companies like MGL and IGL, I think things could be sort of a bit of a challenge for them. So
Okay.
I think overall, very difficult to say for PSUs, but in general, it is good for structural capex plays, and also for
Okay.
a company like Reliance, where things or where will not see the impact of any of the recommendations on their existing or future operations.
Okay. So markets are at all-time high, and Nifty, mid-cap and small-cap are catching up. So let's now talk about the hidden gem. Pankaj, which is the stock that you're going to talk about today?
So I think budget is around the corner. What you see in newspapers is typically discussions around budget. And I think FMS clearly in a recent statement clearly mentioned that I think capex or capital expenditure is going to remain their key focus. Last year, the overall allocation was 7.5 lakh crores. Now, out of this 7.5 lakh crores, 25% was for the road infra. And our sense is that road infra will continue to occupy one of the major allocations going forward. And which is why our sense is that road companies overall should do better from here on, not even from the budget perspective, but even from the execution perspective. Typically, the execution in the H2 or the order wins in the H2 is far more better. And which is why I'm suggesting a name called KNR Construction with a target price of 290. I think it's a fairly known company, stable company, has got one of the best margins, return ratios in the road infrastructure space. They've already sort of executed 6,000 plus lane kilometers across 12 states. Revenue CAGR was 16%. They've got the highest operating margins, 20%, ROC of 20%. And our sense is that overall growth rate would be in double digits and margins would remain at stable at 19%. So I
Okay.
am taking a sort of a relatively less risky approach and suggesting this stock with a target price of 290.
So hidden gem for this week is KNR Constructions, target price of 290, and it's a buy from Pankaj. Pankaj, now next week, do we have some important data that we need to keep an eye on, and how would you play markets at new all-time high?
So, well, I think jobs data is there in US. So if it is too strong, that is also a problem, and if it is too weak, that is also a problem. So, which is
Yes.
why it's still a sort of a challenge. But having said that, our overall sense is that the pace of or the quantum of rate hikes is going to be lower, and with crude overall correcting, probably we might see a positive side of the market more. But having said that, probably some bit of a profit taking can happen of 400, 500 points, and which is why there is no need to panic given lifetime highs. Volatilities are still lower. So we would expect that you'll continue to see a broad-based rally, and you'll see sectors or segments which have not participated will sort of do the catch-up. And overall, we would expect Nifty to sort of keep hitting new lifetime highs, and short-term target stands revised to 19,400. Stay
Pankaj,
positive.
so it's all positive for the markets, and we expect new highs for the markets in coming weeks too. Thank you, Pankaj, for sharing your views on the markets. I appreciate your time.
Thank you so much.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.